by you are naturally a giver. So just take a look at that. It's by Adam Grant. He's an occupational psychologist. Givers and Takers, 13 minutes, kind of changed how I look at things, and may do the same for you. One of the things that's important is I always feel you need to be kind and polite. And it doesn't cost us anything to be kind and polite. So I always recommend to people, why don't we do that every day? It's really important. Now let's talk about what we're going to talk about today. And I'll try, since I know you're all a diverse background, not all in the financial area, to try and keep it top level and not try and get down in the weeds as sometimes I do. But if you do have questions, please answer. Pop up, ask the question. Today's topics: trustees and conservators' responsibilities, delegation and liability reduction. If you're a fiduciary, you have liabilities and you want to reduce those as much as possible because you don't want people coming after you. Okay. Suitability, diversification. What is risk? How do we mitigate it? One of the key things that I shared with Paul a while back is making that decision whether to invest clients' money or not. Whether it's $100 or $100 million, you still need to have some procedures and process in place that you document how you make those decisions to invest money or whether not. And if you did, what level of risk. And we'll talk about some things that will keep you safe and help you make some decisions objectively instead of subjectively, like there's a war going on or there's a virus. Okay. Investment allocation. What kind of allocation when you do invest between stocks and bonds? Take a look at some allocation models and why those are important to even look at. 7 things to avoid. If you're a trustee, here are 7 pitfalls that people fall into, and it's a trap, and we're going to help you avoid those things, even as a trustee and also maybe personally. Investment proposals, court reporting, monitoring, and documenting your decisions. If you didn't document it, it didn't happen. Always document. It's very important. And talk about ethics. Ethics always look at it's like guardrails. If you don't have a good North compass and North Star compass, ethics classes will keep you in those guardrails and keep you from straying out to what you should be doing. And ethics classes are always good. It's one of those things my mom always said. If you have to think about whether you should do this or you shouldn't do it, you shouldn't do it. Just know. That's one of the basic things. Always remember. If you have to decide whether it's right or wrong, it's wrong. Okay. Now that you're appointed a trustee, what do? Delegation. For a fiduciary without substantial investment experience, it's a good plan to have and protective against liability to select an investment advisor. So if you aren't really good in watching markets and it's not your full-time job, being a financial advisor, it's best to hire somebody who does. The prudent investor rule is a test of conduct, not resulting performance. You can't predict the weather, what the market's going to do. You can't change interest rates, can't change inflation, but you can change. And what you can do, you can control your conduct and your procedures and process. We will give you some ideas and some things you can use that you can take home and use every day. Okay? You will be judged on your procedure, not the performance of the market. This is your protection from liability. And anything you do, whether you're doing caregiving at a nursing home or whether you're doing things for your clients, you'll always be judged on your procedures, not the performance of things you cannot control. Okay? Trustee's responsibility. Now that you're a trustee, what do you do? First of all, confirm investment goals and objectives. Write them down. Approve appropriate asset allocation strategy. We're going to have 50% stocks, 50% bonds, or we're going to leave it in cash. Establish and approve an explicit written investment policy statement. If you're a trustee, this is important because this is your roadmap and guidance for the future. Selected investment advisors and currently reasonable expenses. Keep the expenses low. We have a fiduciary responsibility to keep the expenses low in anything we do. because it's not our money, it's the client's money, and we're there to protect them. Monitor. A lot of times people will get an investment plan or they'll set something in motion or get somebody in a facility. And it's very important to monitor them. You monitor these people in the facilities, you go back and visit them on a regular basis. You have to go back and revisit the investments you're doing. Just don't set it and forget it. Avoid conflicts of interest. Very, very important. And first realize what they are and then try and avoid them. Sometimes they're hidden and they may be subtle. So realize that. And above all, we're getting back to the thing of document. Document always. Now, suitability. This is probably one of the most important criteria for whether you should invest money or whether you shouldn't. Is the client's time horizon? Is it 1 week, 3 weeks, 3 months, 3 years? If all the other criteria for selecting suitability for investing, time horizon is the number one. General rule of thought, if the client is going to need the money in the next 3 years, substantially a good portion of it, it's probably leave it in cash or leave it in the money market. Okay. Age and health is another one. Sources of income, total investable assets. Does the person have 25,000 or they have 2,500,000? Okay, or 20 million. Annual expenses. And this is something you should know, or people call it the budget. We like to call it the spending plan. Clients like to hear, oh, they don't want to be on a budget. They want to, oh, you start talking about, well, Jim, let's take a look at our spending plan. They go, yeah, that's good. So take a look at the spending plan for them. Expected shortfalls. Are we looking at a spend down? How long is it going to take? And I'm going to give you some tools that you can calculate, the spend down and how long the money is going to last. Large withdrawals, education, housing, vehicle, those types of things. Limitations or restrictions. Maybe this money came from Uncle George, and these are the stocks he's had for 50 years, and he never wanted you to sell them or something like that. There may be those restrictions, and we have to take those into account. Okay? Deciding whether to invest or not. This is something I've been in the business now 40 years, almost 40 years, been at Oppenheimer a little over 35, and I still struggle with this. We all do, because the market goes up for one reason and goes down for one reason. The reason market goes up because people are greedy. It's a greater fool theory. You see a market go up because, wow, look, I better get in, I better get in. And so greed builds over time. But fear is very acute and falls quickly. That's why people say stock market takes the stairs up and the elevator down, because the emotion for greed builds over time. The emotion for fear is acute, falls quickly. So deciding whether to invest, especially if you're a fiduciary, is really important that you have some solid foundation and objective way of scoring the client so you can document that decision. And we're going to talk about that. Okay. Use objective standards, logical decision making. Ask common sense questions. And we have a questionnaire that we'll show you. It says, how does this meet the beneficiary's needs? Is this the right level of risk? Do I leave it all in CDs, or should I have it all in growth? How long will the funds last? What are the client's income needs? Getting back to that spending plan we talked about. Okay. Deciding whether to invest. Tools to determine suitable investment options. On the next couple pages, we'll show you a scoring system that our team developed probably about 15 years ago, that a lot of guardians have, and fiduciaries and trustees have implemented into their onboarding process when they have clients that have means. It's an objective scoring system. It has 10 questions that you as a fiduciary should know when you set up their care plan and their spending plan. And these 10 questions will rate objectively, score the client. And if the score is below 19 and below, you leave it in cash. Even if it's $1 million, you have to have some kind of system that you use consistently, so when someone questions you, you can pull it out and say, voila. Objective scoring system, quantifiable risk categories. So if it's between this level, cash, next level, boom, next level, boom. And put them into categories because, and we use models to do that. And models would be like a model would be 100% cash. Next model would be maybe 30% equity or 30% stocks, 70% bonds. The next model would be 50-50. Next model may be 60-40. And if you use those model systems and use a scoring system, that means clients with similar investment objectives will have similar investment outcomes, and their accounts will look similar. And there's nothing worse when I go through and I review clients' accounts other places and there's no rhyme or reason. All the performance is helter skelter and there's no consistency because they haven't been using models. And it makes it really easier to review and monitor your accounts if you know that, okay, these are all the accounts that I have that are 70% equity, and or say 30% equity and 70% fixed income, their performance is XYZ. So you look at them, XYZ, they say up 4, up 4.1, 4.2, 4.3, up 3.3, 3.8, 4. And then you see one that's up 8. What's wrong? Or one that's down 2%. Makes it easier to monitor. And these investment models we'll look at are data driven, and we'll talk about the standardized questionnaire. Okay, investment questionnaire. Standardized decision-making, objective decisions instead of subjective opinions. This keeps you away from saying, well, I don't like the market. Oh, there's an election coming up. There is a virus. There's a war. There's whatever. Because those are opinions which really don't matter if you're making investment decisions. Because if you make the right decision and they score, you'll have plenty of time to write these ups and downs. If not, you shouldn't have been in the first place, and the questionnaire will tell you that. Score quantifiable risk categories and models ensures that clients with similar investment risk have similar investment outcomes. Why do we use this? I mean, this is important. And this is why you need to have this in the client's file, even if you never invest a dime. By using objective scoring system, it allows you to document your decision-making process so you can defend in court and with beneficiaries and heirs. Very important. And here's one thing I just thought about I want to bring up that I talk about in other conferences. When you have a client that has marketable securities, say they have $1 million account all in stocks and bonds, and they have 4 or 5 heirs. If you're appointed the executor of that estate and you're in charge of giving distributions out to the beneficiaries, one key thing to do immediately upon your authority is contact those beneficiaries and ask them, do they want these marketable securities in kind? Now, if they do and say yes, get that in writing. I'll repeat that again. Ask them, do they want these marketable securities distributed to them in kind or in cash? Now, if they say, yeah, I wanted, yeah, I'll take these old stocks, I'll have it. Okay, this $1 million account. Okay. Now, think about this. If they want them in kind, and that $1 million account goes down to 850, you're off the hook. But if you did not ask them that, and they get an accounting and knowing when Uncle Jed died, this account was worth $1 million, and over the last 3 months, the market's taken a downturn, and now it's worth 800. They're going to say you should have known, and it's your fault, and they can come after you and sue you. Okay, and they will. But if that marketable securities goes up from 1 million to 1.2 million, they're not going to give you a gold star or a pay raise for being such a prudent investor. So it's really important to get that in writing that they want to hold those marketable securities in kind while you go through that estate settling process. If not, sell it. Just sell it immediately. And once you have authority, put in cash, because that will save you a lot of headaches. Okay. What questions do you have? I'll stop right here. What questions do you have?
What do you mean in kind?
Okay. Thank you, thank you, thank you. That means if you have an account that has Microsoft, that's in kind. That means the stocks that were in the account at the beginning, when this person was alive, those are the stocks that you either can sell or you put in sell, or you distribute those shares of Microsoft to the beneficiaries. So in kind would be giving those shares that were in the account of when the decedent was alive to the beneficiary. If they have 20 shares and their portion was half of it, you give 10 shares of Microsoft to the beneficiary, opposed to if that was worth $100,000, giving that person $50,000. Are you with me?
Yeah. Yep.
Okay. What other questions do you have?
Is there a difference between having actual stock paper in hand and having it on the book somewhere? What's that called?
Those are called book shares. And those shares are held in at Computer Share. Or they will be held in the safety deposit box. So those are shares, either they're held at the brokerage firm, they're held at Computer Share just on the computer, and you get a registry of that and accounting of it by checking the mail, look for dividends, or they're held at stock certificate in bearer form in someone's safety deposit box. They've gotten away from those issuing certificates that go to the safety deposit box because they're very expensive when you lose them. They're hard to find, and a lot of times getting those re-registered is very, very hard. But a lot of people will still have those in their safety deposit box. A lot of times those stocks that are held in the safety deposit box, if there's a split, 2-for-1, only half the shares will be in the safety deposit box, and the other half of the shares will be a Computer Share. So you have to go down and hunt for if the stock is split. But most of the time, the stocks are held at the investment firm, say at Merrill Lynch or Wells Fargo, and they'll have a statement where those stocks are held for them at the company where they buy and sell their stocks. Good question. Next.
Sure.
Okay. Go ahead, please.
This is just something that's come up here in the Boise area with some probates. For quite a while, property in this area has just been skyrocketing in value. And then it flattened and actually dropped some. And in the probate process, I've seen some beneficiaries unhappy with, why wasn't that house sold 6 months ago? We could have got a lot more money. It's similar to what you're talking about, but
exactly,
it can be pretty volatile.
Well, hindsight's better than 2020. It is. People can always guess, and that's where it comes into communication with the beneficiaries. Real estate is harder to sell. It just is harder to sell. But on this liquid marketable securities, those you want to avoid that problem as much as possible. I think those people who are complaining about real estate, they're always going to second guess you. So it's hard to fight that. Okay.
Yep.
All right. Let's push on. When to use a questionnaire. When you request an investment proposal from your investment advisor, fill it out or something, before investing client funds. When reevaluating clients' needs and status, changing the client's lifestyle that may impact the fiduciary, major health changes, changes in spending, financial needs, major contributions. They sold a house and they put the money in the account, revisit the questionnaire. Now, here's what a questionnaire looks like, and you can get a PDF of this anytime you want. We're happy to do it. These are 10 questions. You probably won't be able to read them, but it just goes into things like how much money does a client have? When is the appropriate annual withdrawals exceeding 3%? And each one of these questions has a score. You can see here, score, total amount. Does the client have any outside income? What amount, percentage-wise? You can figure that out. Number 6, likelihood of large withdrawals, significant routine distributions or vehicle in 3 years, 5 years, anything, and you have a subtotal here. And then there's some modifiers we use. Take a look at a little math here. It goes into what percentage of the value of anticipated withdrawals represent income minus investment expenses. What's the age? How long will the money last? And I'll give you a little formula to do all those things, and it totals them all up. This one came up to 43. And that 43 would be balanced income, and that would be what we call a 50-50 stock and bond account. And this is a questionnaire. It takes probably 10 minutes to fill out, maybe less once you get used to it. But it has all the things in it that you will know about the client, and you fill it in objectively. And if it falls in below, like here, 0 to 19 capital preservation, leave it in cash. No matter what, $1 million, leave it in cash. I was talking to a good friend of mine, and she had a client. They had an estate, and they were sitting with all this money, about a couple $1,000,000, and they were going to be paying it out. And this was a couple of years ago when the market was starting to scream. And so the fiduciary was saying, "Oh man, I'm sitting on all this money, and the market's up, and the beneficiaries are screaming at me to invest. How you put this money to work? It's only getting 1% in the money market." So they invested. What happened? It went down the end of the year. And so then she was said, "Now I'm stuck. What do I do? How do I explain this?" This will solve that problem very quickly. 5 minutes, you're done. Okay. And they don't like it, tell them pound sand. All right. Here are models. These are just examples. These aren't the models we use, but these are some examples. Capital preservation, it's all fixed income, all green. Cash, money market, treasuries, all fixed income. Next one, this is an income model which has about 30% in equity, 70% in fixed income. These are probably where a lot of people fall if they're on a spend down. If this money's going to be like lasting for, 4.5 to 7 years or something. And, they probably should be, and they're taking large chunks of it out, taking more than, 10% out of the portfolio at a time. Okay. They'll probably be on an income portfolio. Balanced income, people will probably taking about 4 or 5% out. This is going to last a lot longer. And balanced growth, this is the ideal model that people always look at when they say long-term investing, moderate to aggressive. So this is a moderate account, 60% equity, 40% bonds. So this is what the 60-40 index looks like. And there's a growth portfolio here. This is anywhere from 20% fixed income to maybe 25% fixed income, which is a growth portfolio. As a fiduciary, these models are a lot more conservative than you would do in your personal account, because you are obligated as a fiduciary to be a lot more conservative in your clients' accounts than you were. Like, if you're a growth portfolio for yourself, you're going to be a long-term investor, you're not going to take money out in 10, 15 years, maybe you can go all equity or just a little bit of fixed income. But it's been proven statistically for conservators, it really doesn't pay risk-wise to go over about 80% stocks. It just doesn't. You're taking a lot more risk and not getting enough bang for the risk you're taking. So for a fiduciary account, anything over 80% equity, you're probably just taking more risk for the return you're probably going to receive. Okay. So, but these are models, very simple, and the scoring on the questionnaire leads to the level of risk, and you're documented, and you have all of your clients who are in that risk category will have similar investment outcomes, or they'll be very close. Okay. Balancing risk and return. This is something that we talked about from different asset classes. When I mean different asset classes, I mean like cash, that's an asset class. Certificates of deposit, that's an asset class. Large cap stocks, that's an asset class. International and small cap stocks. The more risk going out here, more return. So there's a risk reward level. And you mix these different asset classes to kind of reduce the risk over time. And that is what people always call the modern portfolio theory. And it's a discipline which seeks to maximize returns and minimize risk by diversifying among different asset classes. And that's what basically you're trying to do when you're diversifying the portfolio with different asset classes. And these are examples of different asset classes. Okay. Now, we're the trustee. How are we going to handle this? Things to avoid: inappropriate assets, incorrect mutual funds classes, proprietary investments, overconcentration, alternative investments and limited partnerships. This is the worst. Fees and commissions. Know the difference. Conflict of interest. Now let's take a look at appropriate assets. As a fiduciary, it's really very important to use mutual funds instead of individual stocks. Individual stocks, you have inherent risk. Mutual funds can go down 5 or 10%. Stocks can go down 50%. Okay, you have a lot more diversification in a mutual fund. And I'll stop here and ask, are most people familiar with mutual funds?
Yes,
Yes.
I'm seeing nodding.
Okay, good. Okay, excellent. All right. So it's, as a fiduciary, you should be using mutual funds. You shouldn't be using stocks. It's a better practice. Stocks can blow you up in a day. Mutual funds don't. The degree of risk is reduced significantly. Annuities. Usually the only person that benefits from the sale of annuity is the person who sold it. Lack of liquidity creates difficulty in accessing the funds or having you recognized as a fiduciary or the conservator or the rep payee, because they don't like to recognize other people. Assets are locked up. These things have surrender charges on them that could go for 10 years. Liquidation penalties could be as high as 7 to 10% of surrender charges, and they have very high internal fees. So annuities, if you see a portfolio is full of annuities, that's a bad sign. Okay. And then we're talking about mutual funds. Mutual funds have different classes of shares. A shares have upfront loads where you put in $10,000, the financial advisor gets 5, say a 5% upfront load. B shares, our industry is phasing these out. These are the scourge. No upfront fees, but they have back-end fees and have very high expense ratios, which means their internal fees are very high. They convert to A's after a period. Okay. C shares are also bad. No upfront, small back-end expenses, back-end load. They may have a surrender charge for 1 or 2 years, very high expenses, and they never convert to lower price or lower fee shares. A, B, and C shares are bad. I shares are what they call institutional shares, which are the honest no-load funds. Okay. They have very low expensive and internal expenses, no front end, no back end. Now, index funds are usually iShares. And what I mean by index fund, an index fund would be a fund that would just hold, say, whatever stocks are in the Dow Jones 30 or whatever 500 stocks are in the S&P 500. They don't try and trade, buy, sell, low, high, or try and think they have some new formula coming out for this new company is going to cause these stocks to go up. There's a manager that's making the decisions in a lot of these actively managed shares, but in the index fund, they just buy the index. Now, actively managed shares are ones where you do have a manager that thinks he's smarter than the market and tries to outguess the market and thinks he may have some formula or some whiz bang thing that he thinks he developed or some formula that can beat the market. Those are active managers, okay, opposed to passive managers, which are just by the index. Now, here's something interesting. The active managers usually underperform their passive index 90% of the time. Think about that. The active managers out there underperform their index 90% of the time. And here's what's worse. those active managers, for every $100 you give them, will charge you anywhere from $1.50 to $2.50 per $100 internal management fees. So every $100 you give them to manage, they will take off the top $1.50 to $2.50 per $100. But that passive manager will take a nickel. For every $100 you give them or her, they'll charge you a nickel to invest the funds. And that passive manager will beat those active managers 90% of the time. So why use them? You're reducing your risk. It's not gonna, these things don't blow up, and the active manager can have, can go through a divorce, get hit by a car, get cancer or something, and you'll never know it, and the performance falls off and it's too late. So I really recommend you use iShares and passive or index funds. There are some asset classes that are inefficient that you can use active managers, maybe like international things that aren't efficient, maybe overseas or some corporate bonds or something. But in the general rule, index funds will do better for you and have a lower cost. I'll stop here and answer what questions do you have. Okay, I will continue.
How do
Now,
you determine what
proprietary.
share it is?
Go ahead. I'm sorry.
How do you determine what type of share, ABC or iShares?
Very good question. Ask the advisor, or you can look it up when you do say there's a fund that you like. It usually has different classes of shares. They'll have A, B, C, D. Usually iShares, when you see something like that, Tian, it is a institutional share, or it may be R, but you don't want A, B, and C. Okay. The others most likely are good, but A, B, and C, stay away. Okay. And look at the symbol, or look it up, or just ask somebody, or Google it real quick. But you don't want to buy ABC shares. B is bad. Proprietary investments. These are ones sold by the investors firm. Say I will pick on Wells Fargo. Say your accounts at Wells Fargo, and every single fund in there is a Wells Fargo growth fund, Wells Fargo stock fund, Wells Fargo bonds fund. Well, those are proprietary investments. Okay. And that's a red flag. Often mutual funds or annuities are proprietary investments. These are investments the firm cooks up in their kitchen and unloads on the public. Usually have high fees, high commissions, and brokers are sometimes incentivized to push these on the clients through cross-selling. And they may get a little bit more money for doing it. It's a conflict of interest. Red flag. Anytime you see that, boom, ask questions, get a second opinion. Now, overconcentration. Large percentage of a portfolio in any one investment. CDs, inflation risk. Imagine if I came to you, the CDs right now are paying really good, and you should have money in some of them, but not all. But there's a place for them. But imagine if I came to you as a money manager and I said, Mrs. Jones, hire me, and I guarantee I'll lose you 3 to 4% of your money every single year that you have money with me. Would you hire that person? No, but that's what happens if you invest only in CDs long term. Because granted, if CDs right now are paying 5.5%, that means inflation is probably running at 8%. When CDs are at 3%, inflation is probably running at 5%. So you're losing your buying power over a long period of time by having all your money in CDs, no matter what. If they're paying 5% right now, your buying power will be gone, will be significantly reduced 5-10 years from now. Single stock holdings. You don't want to have all your money in Microsoft or anything. Everybody remembers Republic Bank and all these things that have blown up. They were great until suddenly they weren't. Okay. All your growth funds, tech funds. It used to be it's not Facebook, it's Meta now. The FANG stocks, Apple, Amazon, Netscape, Google, are all oil stocks. You just don't want to have over concentration, because concentration is a two-edged sword. When it cuts on the other way, it's never really fun. Okay? Limited partnerships, stay away from these things. These things are awful. It's like some kind of disease. They have low liquidity, high upfront cost, high internal fees. These things are black box. You never know what's in them. until next quarter or halfway through the year, and you can't do anything about it because you're a limited partnership. You can't sell it. You're just stuck with them. So they're a black box. K1s, every October, your taxes are late because of the K1s. Just reminds you of a really bad decision you made a long time ago. Difficult and costly to re-register. Sometimes they won't. You're talking to the limited partner. He didn't care about you. He really doesn't. You want to get them to recognize your authority. So that's what they don't care. And these hedge funds are the same things in cryptocurrency. A lot of these things you just need to stay away from as a fiduciary. All right. Fees and commissions. Fees. Know how much you're paying for money management. Usually it's a flat rate if it's a managed account, it's a percentage of the assets. $100,000 account, 1%, $1,000 goes to investment advisor, 1%. Okay. They can be as high as 3%. Some advisors charge 3%, $3,000 for every $100,000. The gold standard is 1% or less. If you're paying, even personally, if you're paying more than 1% annual management fee, you're paying too much. And if the advisor says, I can't lower them for that, they're lying to you. They can. They just don't want to. They don't want to take the haircut. All right. It's 1% or less is this gold standard. At our Lynch Group, we charge 0.85 to 0.5% for management fee. And anything under 100,000, we do as a pro bono to help our fiduciaries out in some of the smaller cases because they probably need financial management advice better than the $1 million account. So, 85, 0.85 to 0.5%, and 100 is pro bono less. But your advisor, get them to reduce their fees. If they won't, they're lying. Take it to someplace else. Okay. Commissions may be variable. A commission is charged when there's a transaction, opposed to an annual management fee. So whenever there's a buy or sell, there's a transaction. It may create conflicts of interest. Excessive transactions. You don't know whether the advisor is recommending this trade because their mortgage is due or because it's a good time to get in and out of this. Excess trading comes in where the term we call churning, where someone is churning, accounts of $300,000 and there's been 500 transactions in it and it counts $300,000 5 years from now. Okay, that's churning. So keep a record of it. And still, if you're buying stocks and selling stocks, the commission on them still should be on 1%, even on a transaction basis. Okay, and very important. Now, conflict of interest, personal bias, interest rates, inflation, you name it, virus, war. There's always something like that. You have to eliminate those things. Okay, those will get you in trouble. And that's why I use the questionnaire to get you away from that personal. I would think personal bias is probably the most defeating factor for investors on the long term. It probably is the number one thing why most investors are not successful is personal bias. Because there's been studies, if you take a look at the performance of the S&P 500 of the last 10 years, over the last 20 years, it's been averaging about 10% per year, compounded over the last 20 years. Now, investors most likely never receive that kind of return because what happens when it goes up, they get in and they get scared and it goes down and they don't get back in until it goes back up and they don't ride out those bumps. So the investor may be getting a return of 4% because their emotions, the reason the stock market goes up because of emotion comes down because of fear. And so they get in here and get out here. But if you stay in the market, time in the market, you could have gotten 10% rate of return. So personal bias defeats most investors over time, and that's why you have to eliminate it for your clients. Proprietary investments, yuck. Self-dealing, don't buy investments from somebody who's selling them out of their personal thing, their gas station. They've got some investment here that's a private placement that's brother-in-law's in, is guaranteed to, rocket that. Don't do it. Okay. Avoid these issues. Standardize your process. Use objective scoring methods. Implement proper controls. Regular monitoring. Very important. Information security. Make sure that you have controls. Encrypted communications with your advisor. Very important. Use objective scoring systems to determine the risk. These are some things that are really, really important. Okay. Work with a fiduciary. Someone who has your best interest at heart. It's very important. because you're fiduciary, and so you want to work with fiduciaries that care about you and your clients. Investment proposals, they can be really complicated. Try and make them simple. Here are some examples. All right. Special needs trust. It should be, you can always have the book of the formulas in back if you go to court or you're presenting. They have all these Wiggs bank charts and all that stuff. But you really want to make it simple so people can understand. Like, for example, here, investable assets is a trust. It's time horizon, 2 to 5 years. Risk tolerance, conservative model. Allocation, moderate. Benchmark, how are we going to compare the performance? Are we going to compare the performance of a conservative moderate account, which is income, which is only 30% equity, to the S&P 500? No, we're going to take a benchmark of the Barclays Aggregate Bond Index, 70%, 30% S&P. We're going to rebalance account. We're not going to let things get over concentrated. Things go up from, we're supposed to be 5%, it goes up to 8% of the portfolio. We're going to trim off that 3, rebalance it back into the portfolio so we never get over and concentrate in any one area. Is it blocked account? Okay. Performance, in-person reviews. Now, this is how you take a look at fees. In a proposal, straight up, what are the fees? How much is this charging my client? And it tells you the benefits of working. How many securities? Increase income for the client. 9 to 12 securities. You don't have like 50 securities in it. That's another thing that bothers me. Get these accounts and they got like 38 securities in it. It's crazy. Proper control, rebalancing. These are all things that an investment summary should kind of look at. And you can use this if you like. Here comes the fun part. Everybody, I want them to take out their phones and go to this website. Now I'm going to give you some time to do it, okay? It's called Money Chimp. Money, M-O-N-E-Y, chimp, like the chimpanzee.com. And this will be a quiz. Okay? You can use this for your clients. You can use this for whoever you like to, just to figure out some things simple that will help you figure out, cost your client, longevity of money. Okay. People there? Okay. Now you can see here, let's put in, say this client has $500,000. Let's put in current principal $500,000. Okay.
Hold on a second. I went to the website, but I don't see that form that you're having.
Okay.
Calculator tab.
Interest rate calculator.
Where's that at?
Calculator tab at the very bottom.
Oh, there it is. Thank you. Okay.
Took me a second.
Okay.
Now we're good.
Okay.
Okay. He's like me. I'm always the last one to figure this stuff out. I like you. Okay. $500,000 current principal. And let's say they're going to add money to this account at $12,000 a year. Okay. And years to grow, 15. Okay. You're looking at retirement, say 15 years. And for interest rate assumption, I always use 5% because anything above that is presumptuous. And I'd rather err on the side of being conservative than being aggressive. So I know that even in a moderate account, you can probably get 8 if you leave it alone, at least 7. But I like to, for planning purposes, I always like to use 5% interest rate. Okay. It compounds interest daily. Okay. Now push calculate. What do you get?
Annual addition. What was the annual addition?
$12,000 and over 10 years. Let's say no 15. I'm sorry, 15. Yeah, I'm sorry.
1.3 million, something.
There you go. Bingo. Get this latest Starbucks card. Remember that. Okay. We got 1.3. And then think about that. This is for your own personal retirement. You can figure out, where we're at, how much money will I have? You can play with the numbers here. You can play with 6%, 5.5%, 15 years, 5 years, 10 years. more money start off with. And so this is just a starting point to get you in the ballpark. All right. Now, I want you to punch where it says that little red arrow right there, hit retirement. Just hit that. Boom. Okay.
Wait a minute.
It comes up to another page. You saw that red arrow where I was pointing? I'll go back. It's right over here. Retirement.
Bottom one. Right. Oh.
Oh, I went on calculated by age. Okay, you second.
Yeah, you'll come to a page that should look like this.
It's the smaller box. Okay. Small box.
Okay.
Yep. Oh.
Now you're on this page. This is something similar. You can play with it also. I don't use it a lot, but it kind of gives you, growth rate. You think about, how much money's coming out on a regular basis. It allows you to play with it to get some ideas. Okay. This is something maybe it could help you with the clients. But the next page is the one that's really, really important. Okay. Now you see down at the bottom, I have a big red arrow.
Mhm.
Says risky retirement calculator. Now hit that.
Mhm.
Okay. It should come up to a page that looks similar to this.
Okay.
We all there?
Yeah. Mhm.
Okay. Now, starting principal. We've just gone through our retirement. We're at 15 years in code. Now I've got $1.311354. $1,311,000. Okay, put that number in there. Okay. Now I'm 65, so I've got 35 years till I'm 100 years in retirement. 35 years. All right. Now, let's see. Let me pull out, let's put in for desired annual income, let's pull out $55,000 a year. So we got 1.3 million in the first one. We got 35 for years, and we got 55,000 for desired annual withdrawal. Now, this formula here, it's adjusted for inflation. So that means that each year, your $55,000 is going to go up by inflation, probably about 3 or 4% each year. You can run this calculation without inflation at a steady 55,000, but your buying power is going away. Now, the next part is your portfolio allocation. 60% stocks, 40% bonds. So this will be your traditional balanced growth portfolio, 60-40. Okay. People with me?
Not leaving anything for
Not
air.
your hedge. No. Okay. Am I going too fast?
Nope. Nope.
Okay. Well, what this does, this takes a look at every 35-year scenario going back to the year 1871. And it'll take a look at every 35-year scenario period going back through 1871. What is your probability of success? Stocks lose 0.25% in fees. The bonds earn 1%. Hit calculate. Now, what is it showing? What's your probability of success in retirement?
94. We said 94. I don't know.
94, exactly. Boom. And that's pretty good. That's really good. Now you can go, well, what if I get greedy? Let's go back and put $60,000 where we had 55. So let's go back and run the scenario where the desired annual income is $60,000 tagged to inflation. So everything else is left the same that you did. Put in $60,000 and recalculate and tell me what your probability of success was.
84.
Bingo. All right. Everybody's on I'm impressed. Very good. Very good. So this is something you can use personally. You can use with your clients. It's just a really good tool to help you out and something you can use right away. And the questionnaire is something you can use right away. And the questionnaire relates to the models. Okay. And this is something you can use right away. Let's see what else. Monitoring accounts. I got a couple minutes. So I'll speed along.
Here's on 113.
Okay. Fiduciary responsibilities, important tool, monitor. You just can't let these things sit. Okay, periodic reviews, you should have these with your advisor. And here's a little document that for your use that you can also use. It just put in the file every time you talk to your advisor and you review the account. Was it by phone, in person? Who attended it? Was this a guardianship? What's the model? What's the fee? Who was there? What things you talked about? What was the performance? Are you happy, unhappy? What are we going to do next? What plan of action? The advisor signs it, you sign it. Safety, due diligence, document your process. When someone says, you haven't even been looking at this account for years. What have you been doing? Whoa, jinga, 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 jinga. There you go. Okay. And ethics, these are, you can look at these at your leisure. I'll let you guys go because I know you guys are probably tired of me, but you can look at those. Those will all be these code of ethics as fiduciary. We've probably talked about these. You never exploit in relationship. I think that should be about it. What questions do you have?
So, hey, Daryl, what if you encounter a relative or a client and they've been using a financial advisor who's got a little shop in an office somewhere, and there's just it doesn't smell right. It doesn't, and you're concerned. Is there any kind of regulatory agency that you can check on to see if that advisor is credentialed properly, or anyone you can reach out to?
There are places you can Google their name, see if they have, everybody's going to have complaints from time to time, but see if they've paid any fines. See if there's repetitive fines, because people can always squawk, and they always do. But see if this person has paid any fines and has any litigation out there against them. Though that's the first thing to take a look at. And if it doesn't smell right, it probably does. There's a reason it doesn't smell right. Okay. Full disclosure, always, ask questions, and see how they're paid. It's very important to see how they're paid. And if they're charging a fee, what is it? And if it's a fee based on the assets, okay, and then how much? If it's under 1%, okay, we might be talking. But then check all these things in the back. Are you using A shares? Are you using I shares? Those are some things they shouldn't have in there. Okay. Do you have a bunch of annuities? Are usually, that's when I see that, I always go, I smell a rat. And if I see limited partnerships, I said it's a dead rat. Okay. Those types of things. Those are the biggest red flags out there. Okay. Then the next one would be A shares. Okay. So if I rank it, partnerships, annuities, A shares, A and B shares. Okay. Then C shares. Any of those things, head for the hills. Get a second opinion.
Good.
Okay, I have a question for you. Do all investment advisors have to be licensed with the state
Yes.
SEC or something, or just a
Yes.
certified financial advisor?
No, you have to be licensed with the state and with the what's called FINRA. So you have to have state registration and you have to have FINRA, which is national registration. Okay.
Okay.
If they aren't, they're selling securities without a license.
What was the second word you said, please?
It's FINRA.
FINRA.
Oh, okay, that's an acronym?
Yes.
But that's only if they call themselves an investment advisor. If they call themselves something else.
No, you have to be licensed to sell in securities. You just do. You just cannot sell securities without a license. And then you can sell unregistered securities, which you shouldn't be buying anyway, without a license. But yeah, to sell securities, you have to be licensed. State and federal.
Okay.
Thank you.
Well, hey, thank you so much, Daryl. That was great and I really appreciate it. And your smiling face is going to be on the World Wide Web on our IGFA site. How about that?
How about that? I hope, well, how about some feedback? Did I go too quickly or some things that you think I could have improved? I tried not to get too down in the weeds, but I wanted to make sure that everybody got a little something there.
I thought it was excellent. Our firm focuses on special needs trusts, so I'm excited to have this as a resource that I can send my trustees and conservators to go and watch. So I appreciated it.
Well, I'm glad you brought that out. I just if you give me a minute here, one of the things that our firm and the Lynch Group, we specialize in that nobody else out there does. We're the only firm that will let you put an inherited IRA inside a special needs trust and not have it be a taxable event. Say, for example, your client was named as the beneficiary of a retirement account. Now, not the trust, they got the third-party trust all set up, but on the retirement account, it was $1 million, and half of it was the named beneficiary of Johnny. Now, that money is his, that's first-party money, but what traditionally happens in an inherited IRA, because nobody will allow you to put an inherited IRA inside a special needs trust, you'd have to take that $500,000, pay taxes on it, pay close to $200,000 in taxes on it, and only put maybe $300,000 in that first party trust. We will allow you to take that $500,000, journal it into a special needs trust, and keep the inherited IRA qualification and not be a taxable event. And more importantly, we will do that all in a calendar month so we don't affect the benefits of your client. So there's never a statement printed with your client's social security number on it. Okay. But we're the only firm that will allow you to put an inherited IRA inside a special needs trust, not have it be a taxable event, and make sure we don't jeopardize the state benefits for your client. For every $100,000, we'll save your client 30 grand.
Yeah, that's great. Thank you.
That's my commercial.
Yeah.
Good one.
That's really good.
I
All right, guys.
I used to be the attorney for the largest retirement fund in the state of Idaho. And what you said pretty much comports to what retirement systems do.
Yep.
Good.
Good. Excellent. All right. If there's not any more questions, well, first of all, are there any more questions?
I don't see any hands.
Okay. All right.
Thank
Well, hey, thank you, Daryl.
Thank you.
Enjoy your stay in Florida.
I will. You guys take care and tell Paul I said hello and
I will.
thanks for the introduction.
Absolutely.
Thank
Okay,
you.
bye-bye.
All right.
Interesting. I think we still